Hey there, this is David Cox, Senior Portfolio Manager at Financially in Sync at Raymond James in Waterloo, Ontario, Canada. Today on the webinar, Where Do We Investors Stand? It is Friday, May the 1st, 2026. Let's get started. We will sort off by week. You can see crude oil back up again. You can tell some of you will have noticed at the gas pump this morning. I drove by, it was $1.90 in Waterloo. Anyway, 9.5% this week. Short, intermediate term, long-term trend. Most of the things here that are rising are up. And you can see on the bottom, we've really got bonds, gold, silver, these kinds of things. So again, there's been a lot of rotation happening really since RAN and all this kind of war recently started, but the stocks have been very strong and we've had a V bottom. Just a reminder, at any time, pause your video player for more information. There's the S&P 500 on the left. You can see that is what I'm talking about, the V bottom, where market basically falls down, massive sentiment change. Markets get very, very oversold. They bounce back to highs. Now, that is not the case in some other markets, including the equal weighted US, but I'm showing here the Toronto market, which has got a lower high to deal with still at this point. Earnings season is definitely upon us, and there was a bunch of big earnings reports yesterday. I just circled a few of them there. These are the biggest 10 stocks in the U.S. and the biggest 3 in Canada. You can see Google was up 10%, Nvidia was down 4.5%, and Facebook was down 8.6%. So again, lots of volatility still to be had here. And again, there's stocks on the moving list here this morning. Remember, earnings come and go and go up and go down. And again, how investors react is very, very important. And we will continue to dig more in. You can see volatility here, which is in the red. It really has collapsed. I mean, it came all the way back, went over 30 and we're down now at 16.5. And then again, that last vertical line there provided by a buy signal, which is, this VIX S&P model that I've shown many times before. It's just the idea that when volatility and fear rises, when fear starts to come back or when the volatility starts to come back in, that tends to be a buy signal for equities. And again, it's just one of these things. You can all remember the saying, buy low and sell high. And I agree, it is tough. Emotions get the better of us. But the bottom line is that it's exactly what happened again. And again, we just got to be aware here that market trends are still upwards for sure. And we want to continue to adapt and react in that manner. This is the Toronto versus US market. So again, there have been a lot of strength here last year and certainly the last kind of 15, 16 months, but it's faded a little bit in the last couple of months. And I think that's important. Again, still an uptrend if you look on the right side here, but on the left side where we've really got this kind of multi-decade trend, we still got kind of a prior high to contend with. I mean, this is still a lower highs, lower low chart. This is Toronto versus the US. So I think there's still some work to be done here. Again, sector composition, very, very different, but again, we'll continue to see what happens. But with gold falling, that is a significant piece of the Toronto market is the gold and material and precious metal stocks, and they've been under pressure since the highs earlier this year. Let's move on. Oops, I'll move twice as fast. There's Oracle I want to dig into again. So on the left side, you can see this is Oracle. Software is this is a big stock and it's the largest holding in the software index. And you can see it's been outperforming in the bottom panel there versus software. But again, that's a 61% sell-off. So after posting, the kind of that bar that we talked about a few weeks ago, you can see here the stock bounced and now it's pulled back here. Looks like it's even pulled back halfway. That looks like the first pullback against. Again, I think this is an interesting area when we're looking at this particular stock. Now, I want to talk about Eli Lilly. This is a very large drug company, and again, has been a really long-term leader, although it goes through periods where, for a couple of years, right, a stock can sort of consolidate and whatnot. But I've shown 3 time frames here. If you look on the left side, you can see clearly there's a 10-year chart of the monthly. Clearly, we had a recent breakout, of course, about 6 months ago, and then we've essentially pulled back, which you can see a little more clearly in the middle panel on the weekly. You can see there we go. We break that trend line in later 2025, and now essentially we pull back, and it's about halfway into that retracement zone, which is a pretty normal sort of spot here. Yesterday they reported earnings, and there's the stock gapping up through the 200-day moving average. I like those kinds of turns. So when you can line up a monthly uptrend with a weekly uptrend, and you put a daily chart on there, and you can see the big price movement on volume, on earnings, and again, that was certainly a buy point from our perspective. Let's just talk about the Mag 7 again here. So these are big stocks, and they've been underperforming really since the fall of last year. The underperformance line you can see here, which is a downtrend in the bottom panel. Now, again, they've outperformed here just in the last month. Now, again, I just showed you there's been a lot of volatility even within those stocks. But again, we want to continue to sort of be aware of this because these are big holdings in the broad S&P 500. But at this point, certainly the broad S&P 500 is back to doing better things than even the equal weighted. So again, remains to be seen here whether we're going to see a breakout for the Mag 7 stocks, but we'll continue to watch. I just want to talk about this. This is I think it's important. Rogers, of course, is a big name in Canadian telecom. Certainly has its name pasted on a lot of stadiums and whatnot. So they just announced in the past week, basically a voluntary retirement package is going to 50% of their employees. Now, I would argue that this is the kind of stuff that you see when falling share prices have been the norm. And you can see here for the last 10 years, for the most part here, Rogers has been falling. Now, it's not nearly as dire as I would argue as TELUS and BC. And so perhaps it's just one of these things where I'd say, hey, maybe this is what is going to come. And certainly we want to be aware of that, right? When companies experience falling share prices, their credit rating starts to deteriorate and their finances are essentially under pressure and their debt ratios start to go up. And that starts to cause some problem for borrowing. And that does cause a problem, certainly for these companies who have a significant amount of borrowing out there. So let's finish off with Sector Watch. You can see there's the energy stocks bouncing up again with crude oil this week. Down on the bottom, we've got those material stocks and certainly the gold stocks that I just actually talked about and everything in between. The next couple of weeks, I will be on the CMT Association Fill the Gap podcast next week, and I'm very excited to be a guest on May the 6th. And then a couple of weeks from now, I will be at the CMT Spring Summit that is in Boston. So if you are going to be in Boston, please definitely kind of find me. I don't think it'll be that big of a crowd, but I look forward to it very much. And please follow me on X. I'm at David Cox RJ. Thanks again for your time this week. This has been David Cox, Portfolio Manager at Financially in Sync in Waterloo, Canada.